Hi, welcome to this video today, which is a tutorial for beginners. We're going to be looking at the structure of the Forex markets and trading it for profit. We're going to be looking at how and why prices really move and what to look out for on the charts. Okay, now in terms of Forex market structure, we are going to be learning from one of the greatest investors, traders ever, George Soros, and his groundbreaking theory really of reflexivity, which I think is an influence on most of the top traders in the world today. We're going to be looking at the techniques that he used and showing you just basically how you can apply them for profit as well. But now, when you look around online and look for information on Forex market structure, you see a lot of education. In fact, the majority of it does not understand the real structure of the Forex markets. The people who basically teach trading it tend to see Forex markets, I'm just going to use a scientific term here, as a simple linear system. Now, they see it as a simple linear system, yet the charting is way too complicated, looking at too many twists and turns going backwards and seeing them as meaningful within terms of the current price action when it actually isn't. Now, in terms of George Soros, he would see the markets as, again to use a scientific term, I'll explain what these mean in a minute, as a complex adaptive system. Now, the paradox is, if you have a complex adaptive system, and any market is a free trading market, then you have to keep your trading very simple and your charting and analysis very simple as well. Sounds paradoxical. I'm going to explain it, but first of all, what I want to do is explain the difference between the two systems. Okay, I'm just going to summarize it here. Now, when it's described in scientific terms, the inputs in the system are described as agents. Of course, the inputs in Forex markets are traders. Just read agents for traders. Now, here's a short summary. It'll take about 45 seconds. Then we'll be back to discuss in more detail. If you don't understand all the terminology, don't worry, I'll explain it when I come back. So here is the summary. We'll get back after that short summary. Now, in terms of a simple linear system, the Forex markets are obviously not a simple linear system, because a simple linear system would be something, let's say, like your car. It breaks down. You get a car mechanic around. He can look at how all the parts interact and decide what's wrong with it. So the parts are all obvious in how they make up the whole. Okay? Now, in a complex adaptive system, the parts, and there's many obviously in the Forex markets, many traders, they make up the whole, and how they interact, you just simply cannot work out. Okay, you don't know what is going to happen in the Forex markets, which would be pretty obvious to most people. A lot of traders still believe in prediction, and they look back on charts and look for patterns and so forth in a very complex manner and think that they mean something. They don't mean anything at all. They only mean something in hindsight when you can look back. They don't help you going forward. When you trade the Forex markets, if you're using technical analysis, you have got to be focused on big levels that matter. And just as important, you need to understand the investor sentiment behind the chart. Why? because you need to work out how bullish or bearish the sentiment is. Now, in terms of when traders react in the Forex markets, they react in many different ways, which creates feedback loops, or in some cases, even fat tail distribution. So what is a feedback loop? Well, a trader might decide to buy a currency and it goes up. Now, a lot of people say the fundamentals are immediately discounted in the price. Let's say he's bought on a bullish news story. They're not discounted in the price, according to George Soros, because that trader can still buy on his biases. And his bias might be greed. He's got a profit, so he buys more and adds to his position after the event. You also get imitation. This is also part of the feedback loop, where traders who are not yet in on the price see it all over the media. It's a newsworthy story that a currency has gone up. They come in and buy. More traders imitate them, come in and buy. And you've got a feedback loop between the environment, okay, and also what the trader thinks. And that can create what we call fat tail distribution, where you get high volatility and big price moves. And you can look at it on a chart. You'll see really big price spikes, okay? And those big price spikes, if they occur in a short time period and on high volatility, you'll see them fade back, okay? And George Soros basically postulated that, yeah, what you need to do is work out the trader sentiment, okay? If you know trader sentiment, then that is going to help you pinpoint market tops or bottoms. So in terms of what we're going to look at, we're just going to look at the views of George Soros. Then we're going to look at simple charting techniques, technical analysis, combined with sentiment to generate high probability trading signals. Now, in terms of measuring sentiment, I'm going to show you a very easy way to do it. Now, first of all, I just want to give you the thoughts of George Soros. Only take about a minute and a half, and then we're going to look at putting together a very simple strategy that you can use to make money in the Forex market. So here is the quick summary. I'll come back after that short summary there on the thinking of George Soros. Now, in terms of technical analysis, it has limitations. It has advantages as well, but its limitations are, firstly, it doesn't, predict anything. Okay, not all the known fundamentals are discounted in the price at all. And if you draw, two intricate patterns going backwards through meaningless levels, it's a waste of time because traders are paying no attention to them. Okay, when you've got imitation feedback loops in place. So what you need to do is keep your technical analysis very simple and robust, then measure the sentiment behind price moves. Now, if you have a big price spike on high volatility to the upside or downside, the bullish or bearish sentiment will peak and prices will fade back to a mean or average price. Okay, done plenty of videos on this. If you want more info, just simply sign up to our mailing list. Now, in terms of measuring bullish or bearish sentiment, how do you do it? You can look around, obviously, on the news wires and see if traders are actually not just talking about the news at present, but anticipating something in the future. And that will normally indicate a bullish or bearish consensus. Now, not a lot of traders are going to want to do this, okay, or don't feel that they have the skills or knowledge. But the good news is you don't have to do it. You can basically measure the bullishness or bearishness of a Forex pair and work out if it's gone to an extreme by looking at a free indicator or report which comes from the CFTC. It's called the CFTC Net Traders Positions. It's our favourite tool in Forex trading. And if you don't know what it is, there's an explanatory video beneath this one where you can learn more about it. But what you can do is you can look for a bullish or bearish extreme on the report, then use your technicals to time. And when you use technicals, just come through big levels. Do not drop down to small time frames. See a lot of people saying they time off the 15-minute, 30-minute or hour chart. That is a total waste of time because that is noise in those periods. You want big levels, big daily levels or big weekly levels. Come through them or look for strength or weakness into them. I'd also strongly advise anyone to obviously incorporate volatility in their trading strategy as well, which is easy to do. But if you prefer, you can obviously just use big levels on a chart, measure the bullish or bearish sentiment, and go with the trade. Now, in terms of George Soros, a lot of people might be surprised by this, but Stanley Druckenmiller, who was one of his partners at the Quantum Fund, actually said he learnt something from Soros which he didn't expect he would learn. What he learnt, he said, was that Soros's predictive skills, i.e., his view on a market, Druckenmiller said, was only slightly better than random. But Soros was the master of basically going against the herd. And he always had really good stop-loss protection as well. So when he lost, he didn't lose much. When he won big. And he didn't win more than half of his trades. It was slightly less than that. So when you're trading the markets, you're trading bullish or bearish sentiment extremes, as long as you use good stop-loss protection, doesn't matter, because when the price spike fades back, you're going to get a big profit on the other side. Also, if you're stopped out initially, you can always come back again. You'll normally get a few bites of the cherry if you don't get it first time round. And you'll find that, we find frequently you get stopped out once, maybe twice on bullish or bearish extremes. Third trade, got the losses back and a healthy profit. And in terms of doing, excuse me, I'm losing my voice. In terms of trading the markets, the structure of the markets, when you're trading structure, think about how markets really, really move. They don't move in the way that most educators would have you believe online, okay? So in terms of if you want to trade the markets, what you want to do is learn from traders who have done it, the great traders. George Soros would be the perfect example. And you can work his thinking and his type of trading into your own strategy. It doesn't need to be complicated. As George Soros once said, the more complicated a trading strategy is, the more prone it is to error. That's very true. Make a strategy too complicated, it's got too many elements to break. So in terms of a trading strategy, the trade structure, reflexivity would be my pick, or a method based upon it. It's a timeless way to make money, because while we can't predict what's going to happen in the Forex markets, what we do know is that humans, traders, will always push prices too far up, too far down, and basically we will then see the price spike fade. So that is the video for today. Hope you enjoyed it. Take care. Have a good day.